Okay, I am going to be in LA tomorrow. I gotta go pick up the boy. Okay, how am I gonna get this? Oh, from current slide. There we go. Okay, I'm like, how am I going to get this to start? So I'm going to go ahead and do a lecture like this so that you have a lecture from me. And you can start on your Chapter 12 homework, and we'll talk about that next week if you have any questions. I have put a lot of videos. You'll find those tomorrow, well, Monday, in your module section so that you can go and check out if you got any questions on homework. There's a lot of answers in those videos. Okay, so we're going to talk about equity. So last chapter we were talking about how to get a large amount of influx of cash into the company really quickly, and we did that through debt, bonds payable. Now this one, what we're going to do is we're going to talk about equity and how we can generate a lot of cash real fast by issuing stocks. And so we're going to talk about these stocks, and we're going to talk about the descriptions of stocks and all that neat stuff, because it's not just as easy as the book likes to make it seem. In fact, it's not as easy as this chapter wants to make it seem, but that's okay. Let's just get an overview of it. So we're going to talk about stocks, we're going to talk about treasury stock, we're going to talk about when you split stock, cash dividends, we're going to talk about stock dividends, how to report equity, and earnings per share. So most large businesses, in many of them that you're going to hear on the news, are corporations. Corporations are considered as, their own entity. They are separate from the shareholders. Now, they're talking in here about how it generates 90% of the total business dollars, and they talk in contrast about small business. So, yes, we got these corporations, and with these corporations, we are going to have stockholders. Now, there's all kinds of ways we can get involved with this individually, but let's talk about from the corporation's perspective. Okay. I've already talked about here that it's its own separate entity. The stockholders are, they're not going to be held liable for any debt that the corporation incurs. In fact, the only loss they can have is their original investment. The vendors, the creditors are not going to come after the stockholders. They can't. It's not allowed. Okay, so we call that ownership interest stock. Okay, you can call them stockholders or shareholders. There's all kinds of different types of stock. And the ones we're going to talk about right now is a lot of your corporations, you're going to see they're probably what we call privately held, which I like to call them mom and pop corporations. What's happening with those corporations is, let's say a family, a mom, a dad and a mom, they get together and they create a business and they're working it, and they set it up as a corporation to protect their family. So normally you see the president as the husband or wife, and then you see the secretary as the wife or husband, however they set that up. So that's kind of what you're going to see in this. And that's what we call a privately held. Privately held corporations do not have to comply with the SEC. However, publicly traded corporations, those are corporations where we are going to go out and I can, as an individual, or another corporation can go and purchase shares of those stocks. Okay, so this is how it goes. Stockholders, they make a determination. They get to determine who's the boss and who's not. And so stockholders elect the board of directors, who hires the officers, and the officers hire the employees. And that's just how it works. In fact, I can't tell you how many times as a stockholder, because I've had investments, and oh gosh, I can't remember. It was like a gasoline company or something like that. And that's the one I can remember off the top of my head. And I would get these notices all the time about they needed my vote to determine who was going to be the board of directors. Well, you know what? Okay, I know this sounds really bad, but I couldn't care less because, you know, I didn't pay attention. And in my opinion, an ignorant vote is a bad vote. So if I don't know who on earth these people are and what they stand for and what they want to happen with the company, and I'm not vested like that, my vote doesn't count. I don't think it should because, again, there's nothing wrong with ignorance. It just means you don't know something. Ignorance is not synonymous with stupidity. Stupidity is when you know something and you still do the wrong thing. But ignorance is you just don't know it. And so I don't feel like that's something I should do. But that's my opinion, and that's my hang up. So you can have your own opinion and whenever you want. Okay? Okay, so here we go. We're still talking about these corporations and the advantages. Now, one of the disadvantages is double taxation. Now, we covered all of this in chapter 1. So I'm not going to go into a whole lot of this. Okay, so first thing you need to do is you need to apply to the state. Arizona's really super easy to go in and apply. Really easy. I think it costs like 10 or 12 bucks every year to go in and renew your corporate establishment. It's so easy. It's not even funny. Okay, so once you go in and you apply, the state gives you a charter of articles of incorporations, and then you prepare your bylaws. Now, because Delaware has more favorable business laws, many corporations are established in Delaware. And so let's go have some fun with this. Okay, so I love to go to the NASDAQ, and I'm going to come over here. Now, I can go and look at a bunch of stuff right here. IPO performance, that means initial public offering. IPO calendar, that's when they originally put out that notice that they're going to be turning into a publicly traded corporation. Let's see, real time options, funds, indexes, commodities, global market. Future. Oh, let's just go look at the IPO calendar. I think that's where I'm going to find it. Okay. So, wow, that was fun. I got Tonga on here. So, every year it's different. So you can kind of see here's some stuff that's happening. Expected IPO date, initial public offering. Let's go check out who they are. And they got all this stuff. Oh, look, they're incorporated in Delaware. Okay, I'm going to go back. And let's go find another one. Jinrong. I don't know if I pronounced that right or wrong. Okay. Hope they don't have a state of incorporation. It looks like they might be not in this country. So let's look at Iron Horse. I like that name. I wonder what they are. Now, you know, if you really wanted to, you could come in here and you could kind of find out what do they do. Delaware, right there. And we come down here. Merger Capital Stock Exchange. Asset acquisition, stock purchase, finance. Okay. So, you know, like right here, you could just see. I'm going to go to this one just for fun. Let's see. State of incorporation. Okay. Oh, look, that's another country. Okay, so 2 were in another country and 2 were in Delaware. So we have that information, and it's kind of cool, and it proves. So, you know, sitting here wondering, okay, why? Okay, I'm going to see if I can put this in correct grammar. Why do corporations want to incorporate in Delaware? Okay. Let's see if I can find something. They want me to file it. Okay, no, I want one of these. Why should it start at? Okay, here we go. Annual minimum cost is one state is having a minimum cost to maintain companies, such as an annual corporation filing. The state laws offers one of the best corporate law structure, which is well accepted globally. Okay, here we go. The other major reasons is the quality of Delaware courts and judges. So basically, you know, legally, it's just better for them. And let's see. Okay, geographic flexibility, tax savings, and efficiency. Okay, so, you know, it's kind of just what I said. But I just wanted to get something from the internet so that you could see a little bit more. Okay, now I'm going to move, I'm going to move this back to where I need it. Okay, excellent. Okay, from current slide. Eventually, from current slide. Okay, I don't know where it went. It went somewhere, but I don't know where. Okay, come on, sweetheart. Okay, let me go check this. It's still recording. I'm going to put that on pause until I figure this out. Okay, I think I figured it out. Let's see. Oh, you got to be kidding. No. Oh, thank God. I was like, no, don't turn it into the Black Death screen. Okay. So it just talked about that. It talked about Delaware. You can see, you know, a lot of these companies. I'm going to tell you that, you know, you got Starbucks, Kellogg. Most of them are incorporated in Delaware, even if they have their headquarters someplace else. And that's okay. So you can incur costs to create a corporation. And so here's what it would look like. This is a GL account that you're going to use once, and then you shouldn't have to use it anymore. So that's how we're going to record that. Which is the following step to create to form a corporation. So I don't know what you're going to think, but I'm going to make an assumption that it's D. Haha. Okay. Okay, I've been doing videos all day long, so I'm kind of like on, no. Okay. Now, with the debt, and when we paid a premium or discount on our bonds payable, we had to amortize that over the life of the bond. Well, we do the same thing here with our equity. However, we call it paid in capital, and it's ours forever. It's just because we were able to charge more. Okay, so number of shares of stock that a corporation is authorized is issued in the charter issued. Refers to the shares issued to stockholders. We can buy our stock back, and we call that treasury stock. Any stock that is, you can have outstanding stock. Okay, most of the time you're not going to get a printed stock certificate. It's just something you don't do anymore. Okay, so this is all the stock I've authorized. Now, I'm going to keep a buffer here. I don't want to put so much stock out that another company can come in and just buy all my stock. And this is how much is issued. And this here is what is outstanding, meaning what's in somebody else's hands. Not in the corporation's hands, but in somebody else's, like you and me. This here is probably treasury stock. Okay. Now, our stock, we have something called a par value. A lot of stocks have a no par value. And then we're going to have a stated value. So par value is when you have stock and it says this is how much it is worth. Okay, this one can be kind of funny because even if I have a par value of $20, it may be selling in the market for $100. Okay, I just want you guys to be aware of that. Again, the par value, the no par, and the stated value has nothing to do with the market price. It's just a value assigned to that stock. Okay. Now, here they're talking about that we have legal capital. That means some of our, you take your retained earnings and set it off to the side for your stockholders. Your stockholders have some rights, and those rights are to vote and to get an equitable portion of the income. And if the company closes, then, you know, if there's any money after everybody's paid, then they get a portion of that. Okay. So we're going to look at two types of stock right now. Common stock and preferred stock. Now, common stock usually says something like $20 par value common stock. Okay, good. Preferred stock, we're going to be talking about this a little bit more. I'm going to say something like preferred stock, $50 par, $4 stock. Okay, I'm going to come in here and I'm going to mention this. Or I'm going to say 8%. What's 8% of 50? It's $4. So either one. I'm going to tell you the par, or the stated value, or whatever it is, and I'm going to tell you how much we have to pay in dividends. Now, sometimes you may have preferred stock that is accumulative, meaning that if you don't pay them their dividend 1 year, then the next year you're going to have to go back and pay them last year's and the current year's. So that's what that means. So I've got common stock and preferred stock. Common stock gets to vote. Preferred stock does not. However, what they do get is they get access to the money first. Now, it's really interesting because oftentimes the board of directors, they're going to sit there and they're going to declare a dividend. And they're just going to say, hey, we want $5 million in dividends to go out. And then it's up to the accountants to figure out how much of it belongs to preferred stockholders, and if there's any left, how much are the common stockholders going to get per share. So it's really kind of interesting to calculate those. Okay, cumulative preferred stock. Okay, there's three things that need to happen in order to pay out dividends. You need to declare a stock, so you need a date of declaration, date of record, and date of payment. So I declare, I'm going to give out dividends. Okay, so directors have to do that. Then they set a date of record. So whoever owns the stock, close of business this day, that's who's going to get the dividends. Okay, so let's say on October 31st, I declared the dividend. November 15th, that's my date of record. And then I'm going to pay the dividend on November 30th, which is my date of payment. So that's how we do that. Okay, anytime your preferred stock is not paid in full, you are in arrears. You can't pay anything until you get the arrears taken care of. So here we have 1,000 shares of cumulative preferred $4 stock, $50 par, 4,000 shares of common stock, $15 par. We paid no dividends in 2021 and 2022. In 2023, they paid $22,000, in which $12,000 was paid to the preferred stockholders. Well, why so much? Well, because every year we need to pay $4,000, 1,000 times 4. And so I didn't pay anything here, and I didn't pay anything here. So that means I need to go back and give them that money. So that's going to be 4,000, 4,000, and then the current year, another 4,000. So that's 12,000. Now they declared 22,000. So I subtract my preferred stock dividends and the rest will go to my common stockholders. So they're going to actually get like $12 a piece, whereas my common stock is going to get $2.50. How do I know this? 4,000 into 10,000 is 2.5. Okay, so let's see if they do. Yeah, there they go. Nice and pretty. Oh, I was looking to see if they put the 2.5 in there. They didn't, but that's okay. So here I'm going to issue some stock. I've got 1.5 million. I got 500,000 in preferred and $1 million in common. Now, in my magic accounting world, I'd have more description. I would be talking about what the par is. I would be talking about this preferred stock. I want to know what that information is pertaining to that. I would want to know how many shares I've issued. There's so much more I'd want to know. So I'm just going to say that to you guys. Okay. So here, just like what happened with the bonds payable, we could issue stock at a higher price than our par. We could also issue it at a lower price. So, you know, let's say again, I've got that $20, and I'm going to come back over here to NASDAQ, and I'm going to go to market activity. And so let's have some fun. Let's have some fun. Oh my gosh. Oh, okay, we're doing okay. Ooh, treasury bonds are down. That's not bad, but it's still not good. Okay, Dow Industrial, these are different markets, okay? So, let's go ahead. We want to see them back. Oh, that's at 11 o'clock. I don't care about that. That's just one day's worth of data. Okay. Your teacher loves this one. Okay, I'm going to grab this one here, Class A. The Class C is a little bit different. And let's check and see what... Oh, they split! I'm sorry. I get all excited. Okay. I heard they were going to split, but I didn't know they did. Look at that. Okay. Google, let's see where it'll show me here. Earnings, financials, dividend history. I don't want that. I want to look at this. Let's look at 1 year. Okay. Okay. Let's look at 5 years. Okay. Max. Okay, they're not going to tell me a lot, but that's okay. I like Google. I think it's fun to look at. Normally, Google is higher. Maybe it's Apple that was. Apple Rush. Let's go Apple common stock. One of these is some ungodly amount. Okay, 138. Huh. Interesting. So let's just go to 6 months. I'd rather look at 6 months. So you can see, whoo, they had a really nice day on August 22nd. Boom. This is, you know what? This is the stupid crap that's happening in politics. I hate to say that, but it has an effect on our stock markets. Okay, who else? I'm going to do Tesla because I like Tesla. I like me some Tesla. Okay. Okay, I don't know if he might have taken this off the market. I'm not seeing anything in here. No, he's off the market. Okay. Or whatever that is. Oh. Well, here's all results. Let's go look at this one. Oh, okay, here we go. Ooh. Look at what happened here. This is Twitter crap. Okay? Sorry, guys, but it is. This is just ridiculousness with the media, and everybody knows he terminated a bunch of people with Twitter. Do I think it, you know, I don't know what to tell you guys. You can make your own opinion there. It says here, will it be a portfolio killer? Okay, I always like to look at Disney. Last time I saw Disney, it was like 160. Let's see if it's... Ooh! I wonder if they split. That's bad. Okay, let's look at 1 year. Nope. Look at that. Remember I told you last time I looked at it? Well, it was back, you know, the previous semester. Look at this crap they got going on. I wonder what's going on. You know, we probably can go in here and find out in the market what's happening with Disney and why people aren't liking them. So you can see here. Okay, so my point. I'm, you know, making this big, huge recording. And you guys want to hear what's pertinent. So you can see here, let's say that the value of this Disney stock, say this is the volume that they have outstanding. Let's say the par is $20. However, in the market, you can see it's $99. It's 101, 106. That's what happens. These prices for the stock are market driven. So you're going to see that with the premium and the discount. Okay, let me come over here and come back over to Warren. Okay, from current slide. It did it again. Okay, I'm just not going to. This is how I did it last time. Okay. Okay, we were talking about stock. We did that, we did that, we did that one. Okay, we're on issuing stock, premium or discount. Premium, we call it paid in capital in excess of par. So let's see what that looks like. So we issued 2,000 shares of $50 par for $55. So basically, I've got 10,000 extra dollars because of the market. Now, remember, we do this with the bonds too. So here's my cash coming in. That would have been listed as bond payable, and this would have been listed as the discount. But that's not what we're going to do in the end. Even though bonds, we had to amortize it, and we had to pay it back, was different. We owed somebody money. Here, we don't owe anybody money. We get to keep that extra money. So that's kind of what I just wanted to tell you. You get to keep it. Okay, premium on stock. So here we purchased some land. We had to figure out what the market price of the land is, the fair market value. So in exchange, the corporation issued 10,000 shares of $10 par. Right now the market price is $12. So we're going to value the land at $120,000. Here's my par, and this is my paid in capital in excess of par. I have crazy dogs tonight. No par, they must know that I'm getting ready to get on a plane and travel. In most states, there's a no par, and you know, a lot of people like it because that par value or that stated value can sometimes confuse people. So it's kind of nice just to not have a par. And so when we don't have a par, whatever we issue it at is going to be the common, you know, that's going to be the amount. So you can see here, we issued 10,000 shares at $40 and 1,000 at $36. And so we're just going to list that for the value that we sold it. Now, let's see here. We can assign a stated value. Now what happens is this is with the state, okay? The state has they put the minimum value, the minimum stated value. Okay, so it would be like, just like having a par, okay? So here's the cash coming in at $400,000. This is my shares. And then this is my, I say paid in capital in excess of stated value. So it could be paid in capital in excess of par. So I'm always going to have that information ready. And then here is the same thing right here. Okay. So, which of the following is not a major right that accompanies ownership of a shares of stock in a corporation. So let's see, they do get to vote. They do get a right to share in the distribution of earnings. They do get the right to share in assets upon liquidation. However, they don't get to hire the corporate execs. Woohoo, right there. All right. Accounting for dividends. Now, this one can be a pain in the booty when we do a stock dividend, but let's go check it out. Okay, cash dividends. Okay, I've got to have enough money, I need to have enough retained earnings, and the board needs to declare it. That's what we need to have in order to pay out cash dividends. Okay, here's my 3 dates I've already told you about. Okay, assume that October 1st we declare a dividend. Okay, I've got $100 par, 5,000 shares outstanding. Well, I want to know, I'm going to look at that, I'm going to say, okay, somewhere in there they've got a percentage. So it's probably, it says 2.5% or something. Okay. Each share is going to get $2.50. And so I got 5,000 shares multiplied by the 250. So that's what needs to be paid to my preferred stockholders. Now I can look and see if I have anything left over, and whatever's left over I can pay to my common stockholders. Now, I don't have to worry about any par or any information like that. I'm just going to take whatever's left over and divide it amongst the shares outstanding. And so that means everybody gets 30 cents. And so this is what we do. As soon as we declare it, I record the cash dividends payable. Once November 10th, that's going to be the date of record. There's no journal. And then here is when I'm going to pay it. And that's it. Short, sweet, and easy. Stock dividends, that's a little bit different. Now this one can be a kind of pain in the, this is the one that's a pain in the booty, because you've got to make a couple extra GL accounts. But, you know, it's not that bad. Okay, so common stock, $20 par. We got $2 million, $40 million paid in capital in excess of par, $9 million, and retained earnings of $26,600. Okay, so that's the pertinent information we need. Now, we declare a dividend, stock dividend of 5% or 100,000 shares is to be issued on January 10th to stockholders on record December 31st. So, date of declaration, this is the date of payment, and this is the date of record. Okay, so the market stock of the price on December 15th is $31 per share. But, check it out over here. Our par is 20. Market is 31. So, stock dividends. Then I'm going to have my stock dividends distributable. That means that, okay, it's not going to be payable because you're not necessarily paying somebody, you're distributing it to them. And then this is paid in capital in excess of par. Date of record, nothing happens. Then I issue my stock. And that's it. That is it. A stock dividend doesn't change anything because basically all you're doing is taking the value that the stockholders have put in and then just created more stocks. So that's all you've done. It doesn't change the percent of equity interest. And in fact, I think we're going to see it right here. Total shares issued after stock dividend. No big deal. You still got 10%. In terms of cash dividends, the date of declaration is the date the board of directors formally authorized the payments of the dividend, the date of the corporation will pay the dividend, the date of the corporation uses to determine which stockholders will receive, the date the corporation announces new investors cannot receive the dividend. Well, okay. Right here. It's going to be B. Oh! Okay, the full monthly date. The corporate will pay the dividends. Oh, nuts. That's date of record. Okay, there you go. Sorry, it's A. I read that wrong. Okay. So in here, a stock split. Again, there's not a whole lot you're going to do. You're not going to do anything in reference to accounting. So here we go. We're going to do a 5-for-1 stock split. It happens all the time. And so let's say the par of each, okay, this par was $100. And we're going to split it into 5. So now the par is going to be reduced to $20. No matter what, the financial value hasn't changed, just the number of shares. So I know for a fact there was I know they were getting ready to, Google was getting ready to split their stock. I don't know how they split their stock, if they did a 10-to-1, 20-to-1, whatever it was. They still have the same dollar value of stock in their financials. However, instead of, let's say I had 10 shares of Google before they split, and let's say it was a 10-to-1, so now I'm going to have 100 shares of Google. But, you know, before my shares were worth, let's say 16,000, well, they're still worth 16,000. Here I have 10 at 16,000, now I have 100 at 16,000. So I've just made a smaller pie. Okay, dividends and stock splits, so you can see that. It's not a big deal. Okay, major objective of a stock split is to reduce the market price per share. Okay, and that has happened. In fact, I'm going to say, I'm going to type it in here. When did Google split their stock? No, maybe it was Apple. Okay, hang on, let me do Apple. Because one of these was... Okay, they have 5 splits. Okay, let's go look. Split history! Okay, here you go. Here's the ratios. They want to push me notifications. What do you guys think? I don't think so. You know, I swear, I don't think they're up to date. Because I know there was a bunch of other ones. Who was it? I'm not going to look at it anymore. Okay, yeah, they haven't updated this since 2020. So anyhow, so you got the gist of it. Okay, where is my Warren? I'm not going to go back to view at the current page because it gives me a bad, it messes me up. Treasury stock is when I'm going to go back into the market and purchase my own stock back. Happens all the time. In fact, when we looked at PepsiCo, you could see it in their financial statements, and I think I said, oh, that's treasury stock. And basically what we're doing is we're going back in. We could be trying to manipulate the market price by pulling our shares in. So supply, demand. I could be pulling those shares in so that I can give them out as bonuses to my employees or whatever the reason is. So you can see support the market price, shares to resell to employees, bonuses to employees. So we use the cost method, which means we get what we get and we don't throw a fit. Okay, so here we go. We have paid in capital, common stock, $25 par, 20,000 shares authorized and issued. There's my excess of par. We're going to purchase 1,000 shares for $45. Sold 600 of those for $60, and then sold the remaining 400 for $40. So let's see what happens in our journal entries. So here I'm purchasing it, and that was for $45. So cost method, I'm going to use whatever it cost me. Here I sold some of those 1,000 shares. I sold 600 of them, and I sold them for a higher stock value. So yeah, $60. So you can see there's my paid in capital in excess, or from sale of treasury stock. And then here I actually had a loss. So that one here, that's going to actually make that only 7,000 in the end. So that's how you do it. This chapter is super easy. How do we report the stock? Well, there's a couple different ways, and I like the more detailed way than the other method. So they're saying here each class of stock is reported, followed by its related paid in capital, then retained earnings, and then we're going to have treasury stock. And then the other ones just puts it all in one big lump. Okay, so let's go here. This is the one I like. So here I can see my preferred stock. It's telling me what's going on. It's telling me that I issued it over the market or over the par price. Here's my preferred stock, excess. Okay, so there's the extra. Here's my common stock. If I did something else with common stock, if I had another type, I'd have it in here. Here is paid in capital from treasury stock. I'm going to keep it separate from down here. And there's my retained earnings, my total, minus my treasury stock. So remember, up here includes this 27,000. So that's why we're taking it out. Okay? So we got to reflect what's truly outstanding. Okay, and here's the other one. It looks sloppy to me. It doesn't tell me what I want to know, and then I'd have to go digging for it. I don't want to dig. Okay, reporting retained earnings. Now, with retained earnings, you may obligate a portion of your retained earnings. That happens all the time. Now, they're talking here that you can do a statement of equity, a statement of retained earnings. I'm used to doing a statement of retained earnings. You can combine that with a statement of income and add the retained earnings in there. It just depends on what you like to see. So here's my retained earnings statement. Now I'm just focused in on the changes with my retained earnings. Now I can put restrictions in place. Could be legal. Maybe the state requires I have that for the shareholders. Maybe I entered into a contract with the bank. So let's say that my bank gives me a line of credit, and they can tell me, hey, you have to always keep $500,000 of retained earnings on your books. And if you don't, then all the loans are going to be called in. So that could happen. And then discretionary, you can say, well, let's put this aside because we want to build a playground. I don't know. And so they could do that as well. They could put a certain value aside. Prior period adjustments. Just put it in your retained earnings. All you're going to do is, let's say that it affects accounts receivable. And let's say you forgot to enter in somebody's accounts receivable. Let's say it's an owner's accounts receivable. So what I found when I had to go research, I found $500,000 of accounts notes receivable that was due from the owner that somebody had stupidly posted into a control account, accounts receivable, without identifying where it belonged for real. And so I had to go back in. Of course, this doesn't affect the retained earnings statement, and I just made the journal entry on the date I discovered the error because it was 5 years behind me, and I wasn't going to go back 5 years and fix all of the financial statements because that affect tax records and everything else. So I'm just going to make the adjusting entry in this time period. It happens all the time. It's not something you want to happen, but it happens. And the beautiful thing about accounting is we just fix our errors. Okay, so you've already been working with the statement of stockholders' equity. You've seen that already. I'm not worried about this. I think you're all very good on that. And reporting of stockholders equity. Okay, for Alphabet, this is Google. Okay, so, okay, you can see they got class A, B, and C. There's different classes, and we don't have to get into that. You can see what's happening. Comprehensive losses, when something extraordinary happens that's not normal. Okay, and here's the stockholders' equity. Okay. Now, I can take my net income minus my preferred dividends and then divide it by my average number of common shares outstanding. That's to get my earnings per share. The reason being is because we only do this on common stockholders. We do not do this on preferred stockholders. So you want to go ahead and give the preferred stockholders their portion of the net income if we pay them dividends, and then the rest goes to the common stock. Now be really careful with this. Even though somebody may say, hey, well, that's what I should get for dividends. Well, that's not going to happen. And the reason being is that we have to, as a business, you got to keep some of this revenue within the corporation, or else you're going to, if you give away all your excess revenue, you're not going to have any cash to expand. So, we don't do that. Okay. It's just a tool to report their financial stability. Okay, you can see this, earnings per share, and we got a discussion activity 1. We're not going to do that. We're not going to do that one, but we will do this summary. And there's equity, and it's beautiful, it's wonderful, it's not hard. So go forth and enjoy the equity, and I will see you on, when am I going to see you guys again? I haven't seen you guys for a while. I'll see you on November 14th. So just at this time, I think at 5:30, I'm going to be in the air, hopefully, going to Phoenix to then go to LA to go pick up my son. And then I'm coming back on the 8th, coming right back. And so I'm not gone for long, so I'll be available. If you guys need me to talk to you on Zoom or whatnot, you can set up appointments. I have people doing that all the time. I don't mind. Sometimes I'm not able to do that, and I'll tell you if I can't. But there's a lot of times I am able. Please note that on Mondays and Wednesdays we have something called Common Hours. So after 3 p.m. I might be involved in meetings. So that one kind of gets a little iffy. But for the most part, you should be able to get a hold of me. Okay. You guys have a wonderful week and enjoy your homework. Check out all the videos I've done, because I swear I've spent my entire 2 days, Saturday and Sunday, doing videos. So I hope this all works out for you guys, and I hope this helps. Anyhow, I'm going to clear all my notifications and get rid of that and get rid of that. No new notification. Get away from me. Go. I don't know what I'm doing. Okay. I'm going to end this. You guys have a great week.